In this presentation, we will take a look at interest expenses related to a sole proprietorship that would be reporting on a Schedule C. We're focusing up here on the income section for our income tax equation, remembering that that income line is supported by a Schedule C, which has both income and expenses, income and deductions, the net of the two, net income, then pulling forward to the first page of the 1040, which is represented by this formula in the income section, looking something like this on line 7. That's where it would pull forward on the 1040. It would then be supported by the Schedule C, line 3, which would also be supported by the Schedule C. Interest. You generally can deduct as a business expense some or all interest you pay or accrue during the tax year on debts related to your business. Interest relates to your business if you use the proceeds of the loan for a business expense. It does not matter what type of property secures the loan. You can deduct interest on a debt only if you meet all of the following requirements. So when you think about interest expense then, obviously, how does that happen? How does interest expense happen? Well, you took out some type of loan typically. This would be the scenario. And now you're paying back the interest. When you take out the loan, you're basically borrowing something. You're basically renting something. Just like if you're renting property, you have to pay basically interest on the use of that property. You have to pay rent generally on the use of property. And we call rent of the use of money interest. So that's what we're going to be paying. Now, if you borrowed money in order to do something for a business use, then it would make sense that you would get to deduct it because you in order to generate the revenue, you needed to borrow the money because you needed the purchasing power of the money in order to help you to generate revenue. And the interest that you're going to have to pay, the rent on that money, is something that you would think would be deductible. If it's a personal item then for interest, if you're just talking about credit card bills that you have because you went on vacation or something like that, or for Christmas presents or something, then that's personal. That's typically personal, and you would think that wouldn't be deductible under the general rules because the personal interest is something that is a personal expense, not a business expense. So the general idea you want to have is, yeah, you could typically deduct the interest expense. However, it has to be if it is something related to the business interest expense. So that's going to be the general concept. So back to our text. You are legally liable for the debt. Both you and the lender intend that the debt be repaid. So you have to actually be legally liable for it. There has to be actual intent that the debt is going to be repaid. It can't be like it's a debt that is assumed. You could think about types of contracts. When you think about this, you'd say, well, of course that would be the case normally under a normal condition. But you could think of types of situations where people may want to try to deviate from that to basically take the deduction. And oftentimes that is in a situation of friends or relatives where that kind of situation, you'd have a weird situation like that. You and the lender have a true debtor-creditor relationship. And again, it's skeptical or things get kind of more difficult to analyze when you're talking about people that are family or something like that, because then there's a question as to whether you have a business relationship, which you would think would be driven by market forces and whatnot, as opposed to other things driving the reporting. So certain taxpayers are required to limit their business interest expense deduction. See the instructions on Form 8990 to determine whether you are required to limit your business interest expense deduction, who is required to file Form 8990, and how certain business may elect out of the business interest expense limitation. You cannot deduct on Schedule C or CEZ the interest you paid on personal loans. So remember, this is the general rule, right? If you have personal loans, that's a personal expense because you rented money to do personal stuff. But if you have business loans, then you would think that would be a business expense because you rented the money to do business-related stuff and you needed that in order to help you generate revenue. Therefore, the rent on it, the interest, you would think deductible. If a loan is part business and part personal, you must divide the interest between the personal part and the business part, which again would make sense. What if you took a loan out and you used some for business, some for personal? You don't really want to do that if you can avoid it because that's confusing. But if you do, then the rent you paid on it, you'd have to break out in some way. The interest, the rent you paid on the loan, you'd have to break out in some way to the business and personal portions.